we're talking about just texting, happy holidays, whatever. And very grateful for you and your direction. And to me, they're super happy with what they did. The move was very successful, and they're really, really happy. And to me, just that little line about being grateful for our direction means the world, right?
You changed my life.
Right. We changed
your
life.
You.
Exactly. And I think you said it best. You think you're not making a decision, but you are making a decision by staying where you are. And a lot of times we go through the economics with advisors, and we'll show an advisor that, if they're considering going from a W-2 environment to a 1099 environment, right? Without choosing a 1099 firm, an affiliation, we'll show them like what the cost of inaction is.
Welcome to Advisor Talk with Frank LaRosa, brought to you by Elite Consulting Partners. It's the only podcast offering unfiltered guidance and the direct advice for all things concerning financial advisors, RIAs, and the practitioners in the wealth management business. And now, welcome to the show.
Hey, everybody. Welcome to Advisor Talk with Frank LaRosa. I am your host, of course, Frank LaRosa, and joined, as always, by my co-host, Stacey Frank.
Happy to be back.
How are you doing?
Welcome, everybody.
That was good.
Yeah.
Yeah.
We did rehearse.
A little bit more energy. That was take 2, by the way, for anyone wondering. We didn't have the microphones in front of us. So anyway, so welcome back. Thank you for joining us. Today is going to be an interesting podcast. It's going to be a culmination of a lot of different topics, really 6 in particular, that we viewed as hot topics in 2025. Podcasts that got a lot of traction, podcasts that got a lot of views, and to us that means that they were of great interest for our audience. So, and if you're joining us, once again, we appreciate everybody listening. I love when I talk to people and they say, hey man, I listened to a bunch of your podcasts, they're great, et cetera, et cetera. I really appreciate that. We really appreciate that. That's why we do this, because our job here is to really help provide I would say agnostic information, content for viewers and listeners.
Keep it real.
You keep it real. We are a CEO of a large major a large independent firm. No Freudian slip there. A large independent firm. Described me as a myth buster, which I thought was a high compliment. Because we just speak the truth. We just tell like it is, good, better, and different. I feel like that's what you deserve as a financial advisor and in the community. So, so today we're going to talk about really six things that were front of mind and on a lot of people's tongues this year, in no particular order. So we're not going to go like, oh, this is the number one topic. It's just areas that we found were really, really trends within the industry. So
yeah, and I think every time we would talk to a financial advisor, when we collaborate with our team, it's like, wait, I just had that conversation with an advisor. Oh, wait, me too. So there were a lot of repetitive themes that we would recognize, and,
right.
And those are the hot topics.
Yeah, I think so. One of them I want to start with, which is as a business owner. Data is near and dear to my heart because as a business owner, you need a lot of data to help you make better and more informed decisions. And, data and data integration and CRMs and all this stuff were a lot of topics this year. In addition to which, we'll talk about sort of consolidation and private equity and all this other stuff, but valuations, right? And one of the things that advisors are starting to learn today is that not only when a buyer is looking at your practice as a purchase, do they look at revenue and all these other things, but one of the factors that they take into account to determine what they're willing to pay for your business is the data that you have and the quality of the systems that you have for client information, prospect information. And so, almost like back in the day, an advisor thought their CRM was really just a Rolodex. Right.
A holding tank of information.
Yeah, a holding tank of information. It was static. It didn't really do much other than just, hey, that was where the information was, right? But nowadays, you need to have that system work for you through automations and workflows because every practice that we talked to today, has almost doubled in size over the last several years, right? And so you have to, as a financial advisor, be much more efficient with your time and your business and your, I'll say the tasks and marketing, whatever it is, in order for you to manage your business appropriately, maintain good earnings, net income, right? And the way to do that is by using data. And so that was one that we really spent a lot of time with. And we also talked to a lot of, I'll call them buyers, professional buyers, acquisition firms. And that's one of the things that they tend to ask us is, well, what does their data look like, right? Not only the client data and prospects and all that other stuff, but, a firm looks at an acquisition target, and when they ask for information, whether it's P&L information, whatever it is, the turnaround time in which an advisor can get that information is a telling tale about how that practice is run, poorly or not poorly.
And I ask advisors that exact question is the way that you can determine if your data is quality at all is how are you using that data? Is it usable, and how are you utilizing that data to make informed decisions or even better decisions about your business? And oftentimes when we ask an advisor that question, there's sometimes a pause, and so then it evolves into, well, we need to talk about that.
Right. If you, again, speaking from personal experience running a large business, the more data that we collect and the more data that we have on our business, the more informed we can make decisions. And some of those decisions mean saving money. We're not talking about always growing the business, right? Some of that stuff helps us grow the business. But some of our decisions that we make through data and understanding our data help us save money. And so that's what firms look for when they're looking at acquisition targets. Do we have to go in and figure everything out from scratch because their data and their system is so bad? It might take us 6 months to get our arms around how effective and efficient does the business really run? Or is that information readily available at the click of a button? Because if it is, I'll pay more for that business because I know that I can, with that information and our team, the buyer's team, we can help turn that revenue around much faster, right? So that's one of the areas that we've talked about. And again, we're not going to get into, not going to redo every single episode here, right? But data as an asset is something that advisors really need to think about, and you all need to think about that. Do not look at it like, well, it's just a means to an end, and it's not really important. It's really important, more so than ever before.
Yeah, and if it's just existing in a CRM or in a spreadsheet, then it's not really useful. But it's the way that you're using it or displaying it even more so, dashboards and so on and so forth. If it's accessible, then it can be utilized effectively. If not, then probably just sitting in a holding tank situation, that's not very effective.
Right. So the next one, which is, not going to be a surprise, but sort of an industry in consolidation, right? The reality that the industry continues to consolidate, right? Obviously, no surprise, the biggest announcement of, M&A, there was a record year in M&A, both on the independent broker-dealer side, individual advisor side, and on the RIA side. I don't think it's going to stop. We're going to cover that. Later on. I think that it will continue to. We're going to do a sort of another recording that will really talk through where I think the industry is going and what I think is going to happen in 2026 and beyond. No surprise, consolidation will continue to be on that. But this year, the biggest one was LPL acquiring Commonwealth. That created a ripple effect. In my opinion, it created a ripple effect in the space because the deal was so aggressive with, meaning that LPL acquiring Commonwealth and then the retention deals, I should say specifically, were so aggressive for LPL to maintain and retain those Commonwealth advisors that it made all of the other firms that were trying to go after those advisors step their deals up across the board, right?
It was a ripple effect.
It was a ripple effect.
Yep.
And not only did they step up their deals specifically for Commonwealth advisors, but by doing that and not wanting to be, I'll say, sued for targeting or rating, something like that, right? Most of the firms raise their deals across the board for every single recruit out there, regardless of the firm that you came to. So if you were an advisor and you went from, I'm just picking out names, so don't take this the wrong way. You were an advisor and you went from LPL to Cetera, or to Cetera to Osaic, or Osaic to Cetera, or wherever the deck chairs move, right? And you got an ultra aggressive deal. Really, you can thank LPL for that, because they're the ones that sort of like rising tides lift all boats, right? Well, that's what happened, right? And so I think we'll continue to see that. I was actually on a call this morning with a client, and he was talking about, he's unsure what he's doing. He's at a different firm. But he's unsure what he's doing. And he's like, well, Frank, but these kinds of deals, they're always going to be around, right? And my answer to him was yes and no. And he's like, what do you mean? I said, well, I think that there will always be deals around. And I think those deals will be higher than what they were 5 years ago, right? But I don't know if they're going to be as high as they are today, because I think interest rates are going to continue to trend down. And when that happens, these firms make less money on their cash balances and their cash reserves, and which is one of the reasons why these deals came up and are at the levels that they're at, right? One of the ways that LPL is going to be able to make money on this Commonwealth deal, because but I'm not going to get into what they're actually giving the advisors, but in my opinion, one of the ways they're making money on this deal is for the billions of dollars in cash balances that they're bringing over from Fidelity that will now be on LPL's custodial platform. And so they're making money on that, right? I don't know how long that's going to last when interest rates continue to trend down. Now, I'm not an economist. All I know is the majority of the people in this country think that interest rates are going to come down. So I'm just going with that, right? So I just don't know if the deals are an all-time high. But I still think there will be consolidation, because I still think that, and we'll cover this in sort of in another section. I still think that the advisor population continues to get older. It's not I think. We all know that that's the case, right? And there are a lot of firms out there that are being run by very successful, I'll say they were once an advisor. Now they're running their own business, right? And whether it's an RIA, whether it's a small independent broker-dealer, there's something still like 13 or 14,000 independent broker-dealers that will still consolidate. I'm sorry, not that was RIAs. I mean 14, 15,000 RIAs, something like 4,000 or so, 1,300 independent broker-dealers. So I still think there will be some consolidation there, because at some point, the principals of those firms, the CEOs, the founders of those firms that are generally speaking in their late 60s to early 70s are going to look for an exit. And, I don't see many of them creating ESOPs. There's a couple that are doing that, right? Employee stock ownership plans. And I don't see many people doing that. It's very complicated to do. And honestly, the founders don't really get the kind of multiples that they can get in the marketplace. So I think that you're going to see a lot more of the CEO founders heading towards the doors and using this opportunity to sell, and how that affects the financial advisors. I'm not going to say they don't care, but maybe they don't care as much as they used to care.
Well, and this is a good segue to the conversation that I feel like we have with our advisors all the time, is when a financial advisor is at a firm that is threatening or about to go through an acquisition, does that advisor want to continue to be in the driver's seat? And the question is, if you were to have a blank slate and choose the firm that you're currently at that's being acquired, or have the choice to go somewhere that maybe is a better fit for you, your clients, how you want to grow your business, 9 times out of 10, the answer is, well, of course I'd rather make the best decision for me. So do that. Don't let the acquisition landscape or the environment that we're in make the decision for you. And so We're constantly having this conversation, and the answer of most business owner is, well, of course I want to make that decision for me and my business and my staff.
Yeah,
of course I do.
The other where I thought you were going to go with this is if you are in a situation where your firm got acquired or recently got acquired, what you should be asking yourself is, okay, and this is what I was talking to this advisor about this morning. If you were being acquired, I use the example of LPL Commonwealth. I said, let's say you were a Commonwealth advisor that left LPL and you left LPL to go to Commonwealth. So now you made the decision, someone made the decision for you to go back to LPL. Like, why would you already made a decision to leave that firm? So why would you make a decision to go back to that firm, right? Or one of the examples that we've used in the past is the firm that you're being acquired by, if you were to decide to go to any firm other than the firm that you're at, would you choose that firm, right? Just like we talk about, if you were exploring your options all over again and you were at ABC firm, right? Would you choose your own firm to go to, knowing what you know about the firm today? And a lot of advisors are like, no, I wouldn't. And then it's like, then why are you there?
Why are you there in the first
Right?
place?
Then why are you there?
Right.
And so, we talked about that with this other advisor. I just said, listen, if you get acquired by another firm, you're going to have to make a change. So when you get acquired, just so you all know, when you get acquired, firms give you retention money, and it's fine, it's good. But it's never going to be as much as another firm is going to pay you to move your practice to them individually, right? Or as a group or whatever, doesn't matter. So in both instances, you're going to go through a change, whether you like it or not. And in one instance, you're going to have some money. In another instance, you're going to have probably 2x that much. That much.
Right, because those firms outside of your existing firm, they know that they have to earn your business.
Yeah, they have to go way above.
Right. They're competing with the whatever number of other firms that are after your assets and your business as well. So put yourself in the driver's seat to make that better decision.
Yeah. So the other trend, we beat that horse dead.
It's dead.
The other trend that I see happening that we've talked about, and I got some great feedback on it, was this idea of swimming upstream. And what I mean by that is there are a lot of advisors that they don't want to be in a W-2 environment, or they were in they were in W-2, they went independent, their business grew, they're a little bit older, and they are sort of run down or beaten down or whatever you want to call it, with actually running the day-to-day of their business. And they're choosing to go back to a W-2 environment, but in an independent structure. It's why you see firms like LPL and other firms. Raymond James has always had that kind of structure in that you're W-2, but you still have ownership of your book and all that other stuff, right? But there are other firms. I got an email today from a firm, and they're like, yeah, we have 3 models. Our newest one is a W-2, like an independent W-2 advisor, right? So they're W-2, but they still can use their own brand. There's lots of things that they can do. I continue to see that as a trend. I also, which we'll get into the next, and when you talk about deals and PE and all that other stuff, the reason why I see some of this as a trend is because PE, which is really the next topic, right? So the PE evolution. Some advisors, there's always going to be PE out there. I think there'll be more private equity, family office, aggregators, those sorts of things coming into the space. But advisors are starting to wake up, at least some of them are starting to wake up, and realizing that even when a private equity firm buys a minority stake in your business, it's still a stake in your business. So now you have a partner. So you really can't do all of the things that you would normally do if you didn't have that person sitting next to you, right? And so you're, in a way, sort of like a W-2 employee of that company, right? Because now you sort of have to ask permission for certain things. And the appeal of the money sort of goes away when an entrepreneur, business-minded individual starts to realize that they're going to start to lose some control. Enter this W-2 option, right? So why not go to a firm that has a W-2 option, but it's underneath an independent umbrella?
Kind of the best of both worlds.
It's the best of both worlds, right? Because you're going to get a transition package that's similar to going to any other W-2 firm. But the difference is payouts, although W-2, right, are still higher than if you were at a Morgan Stanley or a Merrill Lynch or a Wells Fargo, whatever, right? So because they've taken out the fluff of middle management. And so what they've done is they've narrowed the gap in the difference between the net number when you're running your own practice as an independent advisor and the number that you are going to get as a W-2 advisor, where the firm is not going to do everything for you. So I think that, again, we can cover that again in a whole other podcast. But I think you're going to continue to see that as a trend, because there's a lot of people that just don't want to run the day-to-day, but they want to be in an environment where they have some flexibility. And the other reality is, and I talked to an advisor about this last week. He does it. I think he was doing like $400,000. And I just said sort of professionally, like, hey, don't take this the wrong way. But, you don't really make enough money after your expenses and stuff like that to have a meaningful difference between W-2 and 1099, right? And, if you're – and he understood. And so my point to him was the amount of money that you're going to get if you go into a W-2 structure where you still own your own business and all that, and the payout that you're going to get is not going to be that far off of what your net would be, because you don't have the margins. You hire an assistant, well, that's going to eat into your margins. You're going to pay her $65,000 or $70,000, and you're only doing $400,000 in production. That's a huge piece of your revenue. So those are the types of things I'm starting to see happen more and more. The other thing is dual monetization as part of that, which we trademarked, and that is advisors are realizing, instead of selling to a private equity firm, go to a W-2 structure, take the deal from them, and then sell your business to either to the firm or to a partner that you have on your team, and you've monetized your business twice, which is probably more than ultimately probably more than a private equity firm is going to give you. That's a shift I see coming. The other one I said number 3, in my opinion, again not in particular order, but number 3, talking about economics and all that stuff, is really the evolution of the deals, right? And we talked about that a little bit. The deals have gotten better, but I think firms are wising up. Multiples have not come down; they're still continuing to be pretty high. Getting but I think the trend or the difference is advisors are starting to realize that when they hear their buddy say, "Oh, I got 15x."
On what?
Right? A year or two ago, it was like, "Oh my God, they didn't understand that multiple is paid out on. It could be paid out on different things: top line revenue, gross revenue, net income, right? EBOC, EBITDA, whatever you want to call it, and those numbers all mean something different, right? So a 4x on revenue and a 15x on EBOC are very similar, right? And so don't fall in love with the headline number. Make sure you understand what you're seeing.
What is it on and
right?
What is it based on?
Right, exactly. But again, one of the other trends, which we sort of touched on, was I think that I still think that there'll be a lot more money coming into the space. But I think advisors are becoming more educated and are being more deliberate in taking those deals, because what they've learned through other advisors that took deals earlier on that were less educated, it's, I want to say hard, but I might say impossible to unwind those deals, right? Once you sell to a firm, it's near impossible for you to get out of that deal if they sold you a bill of goods, if they didn't deliver on the things that they said they were going to deliver on, right?
Yeah, and it's important for the advisor, we talk about this all the time, for the advisor to understand what's the true intention, what's the culture of the private equity firm or the investor that's coming to the plate for you. You have to understand what is their short-term goals and what is their long-term goals.
Right.
And is the private equity, is it an opportunity or is it an obstacle?
Right.
You have to compare and contrast those
Yeah, how they going to help you grow, right? Because ultimately, if you take some of these basic deals, I'm not saying, if it's a 20x multiple or whatever, but what we've seen time and time again is that you're essentially in the first 5, 6, 7 years of you doing the deal, you're effectively paying yourself with your own money, right? Because the money that they're taking from you, if you owned 100% of the business, growing at a reasonable rate, it's the same money, right? So after 6 years, 7 years, you're effectively underwater, meaning you would have made as much money if you didn't do the deal than if you did do the deal. And now you only own 80% of your business or 70% of the business or whatever. And so I think advisors, thankfully, are starting to be a lot smarter with that.
And so here's a quick question, and then we can move on to the next topic. But it's definitely different because I've worked with advisors that are in their mid-40s, and I've also worked with advisors approaching, 65, 70 years old. So at this juncture, what would you tell an advisor in their mid-late 40s that wants to monetize exponentially greater than what they can do just, selling their practice to their buddy or taking a minority stake? I mean, this is a really critical conversation.
Yeah. They have to figure out, do they want to do it on their own or are they comfortable doing it with partners? And the partners have to bring more to the table than just a checkbook, right? If they're just bringing a checkbook, that's the wrong partner. So you have to, was that the right answer?
I walked you into the trap.
So you have to, just so everybody knows, we don't rehearse this. Like we have some notes here, but they're basic notes, right? We don't rehearse anything. Maybe we should sometimes, but we don't. But you have to look at what's it going to be like working at that firm. Not forget about the money. You have to put the money aside. What's it going to be like working for that firm? And what are the things that they're going to bring to the table that are different than what I have today and that are going to help me grow? And then show me examples of it. Meaning, let me talk to advisors that you acquired part of their practice however many years ago. And what is that practice done? And can they attribute that growth to the firm that acquired them? Because over the last, let's just call it arguably 10 years or so, maybe 11 years, the market's done nothing but go up. So,
it's phantom growth.
Yeah, so it's really phantom growth. Like you could, like they're saying, a blind squirrel finds a nut, right? Like even an average advisor that really has no marketing plan or growth methodology or whatever, grew their practice over the last 12 years, right? So, and the firms. Some of these firms are saying, oh, we help you grow. Look at these advisors did. Okay, well, show me the advisors that grew at double digits, and what about the resources that you as the firm provided them to help them grow, right? Like I was at, I just recently was at in Tampa at the Raymond James IBEX conference. IBEX stands for Institute for Business Excellence. And it's basically, it's an internal program that all the Raymond James advisors were there. And they teach advisors how to work with business owners, whether it's exit planning, all different strategies, not just selling their business, but growing their business through lending and different structures, right? That's a tangible thing that Raymond James can show their advisors or recruits on. This is how we help our advisors grow, because this advisor was doing X. Now they're bringing in 20, 30, 40, $50 million a year because they're part of our mastermind program, our mastery program, which is not mastermind, but this mastery program. This is what they were doing when they started with us. This is what they've done now. They've done 12 deals. They've done whatever. That's what I'm talking about. And those are the types of things that you have to look for when you're deciding what I call a forever partner, right? Which brings us to our next topic. One of the things we talked about was, part of our mission is we help advisors make the right move, not just the next move. And so you really have to think about what is that right move, which means not just for tomorrow, not just helping you sort of get away from a problem that you are having, an immediate problem you're having with your manager or a compliance person or whatever it is, but is the new firm that you're going to go to, aside from giving you oodles of money, is the new firm that you're going to go to be the right firm based on your goals of where you want to take your practice, right? So when I ask an advisor, what do they want to be when they grow up? It really means if you're doing $5 million today, 5 years from now or 10 years from now, where do you see that business looking like? Do you want to be an enterprise business owner? Do you want to be doing, 20% better, but have, more of a lifestyle business, right? Taking more time off, traveling, whatever. Or do you want to go from 5 million to 40 or 50 million, right? I talked to one advisor and I was super proud of him because I asked him that question. He says, by the time I'm X years old, which was about 10 years, I want to have a $100 million exit, right? And we were talking about a couple of different firms, and then he called me back and he said, hey, I thought about your question because I didn't really understand it but I really thought about it. I was driving. I was really thinking about what you asked me. And he said to me, which I was just amazing me how advisors think. He said, I know this might sound over the top, but by X years, essentially 10 years, I want to have a $100 million exit. And my response was, I'm glad you told me that, because that changes the direction of some of the firms that we are going to talk to, right? It's not just for him now. All of a sudden, it's not just about, okay, we're going to go from firm A to firm B because they have a better, I'm just making this up, technology stack or alternative investment products, right? No, because that firm has a specific strategy. The firms that I'm looking at for you have to have a specific strategy for you to be able to exit there versus like, okay, I want to have an exit. Now I got to move again.
Right. Well, you're not just building a solo practice for that kind of exit.
Yeah, it's him and three guys. Right, exactly. So, making the right move, not just the next move, is really important. And so when you're going through this process, you have to think about where it is you're trying to go. What stage of your career are you in your life, right? And where do you see yourself in the next 5 or 10 years? And those are the types of factors that you have to take into account when deciding on where to go. So that was a big one for us. Another one is, which I love, I find this one very interesting, is the shift. And sort of this is maybe sort of worked out this way, but this whole idea of what do you want to be when you grow up? Where do you want to grow? What we're seeing with advisors is they're moving from practitioners to CEOs, to founders, right, to entrepreneurs. No offense to everybody that's in a W-2 environment, no matter how big your business is, you're not a real entrepreneur because you are not paying the bills, right? You are not paying, if you're in a W-2 environment, even if you're in whatever, I don't care what firm, if you're running a $20 million practice, but you are in a W-2 structure, which means the firm pays the rent, pays most of the sales assistants, pays for the technology stack, pays for everything, right? You're a successful practitioner, but you're not a business owner, right? And so we are seeing this trend because as we see more and more advisors going independent, starting to own RIAs, we're seeing a bigger trend with advisors leaning into the idea of becoming a real entrepreneur, right? And part of that, and we've talked about this in some of the coaching sessions that I've gone, is like, when you have that mindset shift, it now all of a sudden doesn't become about you and how can you do more business. It starts to become you surrounding yourself with a team so that the firm as a whole could do more business, and you become less of an important piece of the growth of the business, right? That's where you're trying to get to, and I'm proud that we're starting to see a lot of that because 5 years ago, maybe, I mean, you've been here for 8 years or so, and it was really not really a lot of people talking about that.
No, not so much. You're just kind of doing your day to day. Everybody's doing their thing, but it's not about profitability and exponential growth and building efficiencies and growing into an enterprise. Like that conversation probably wasn't really at the forefront.
It was, well, I'm the advisor. I'm the guy or gal that I go out and find the clients. I manage the money because I'm really good at it. So I'm going to continue to do that, right? And I'm gonna go out and I'm gonna bring in new assets because I'm the best at sales. I'm the best at networking and all that other stuff. What we're seeing today is advisors are starting to realize they can't do all of those things. If you go back to sort of the evolution of the deals, advisors are also starting to realize that them running the money, even though they maybe egotistically like the idea of saying, I run my money, it's actually hurts your valuations. And so advisors are starting to learn that. And so that's great for essence.
Just too narrow. I just had this conversation this morning with an advisor that loves building models and loves, being intricately involved in the investment strategies. But he realizes that to go from, his $50 million practice to go to $150 million of growth, he can't spend, 30% of his time doing that. It's
right.
It's inefficient.
Right. Yeah. Look, and it comes back to the industry consolidation piece, right? There are a lot of, I'll just call it businesses, whether it's an independent business or an RIA, right? Independent broker-dealer business or an RIA. And even more so, I think there's going to be more consolidation in the RIA space for the reason you just said. Years ago, advisors went RIA because it was easier to do. They can make more money, and it was great. They run the business.
More autonomy,
all that other stuff, right? Now there's two things that have happened. It's gotten tougher to manage.
Mm-hmm.
The SEC is just as difficult as FINRA, and the business has gotten significantly bigger. The problem is, as the business has gotten bigger and more employees, they're spending more time on, I'll call it, so like in the weeds of running the business itself, and not as much time going out and doing the thing that they love to do, and that was working with clients,
right.
working with prospects, and they've seen a stagnation in their business growth. And so the reason why we're seeing this shift, obviously, into the entrepreneurship, but the shift in consolidation is because advisors are starting to realize that, you know what, I'm spending so much time running the day-to-day that I've lost sight of what I love to do. I might be better off rolling up my business, still owning it, still meaning still running the business itself, but being part of a larger organization where I can offload those day-to-day operational things, that I don't like doing anymore, that are taking up half my day. And then we're seeing growth that way. So this consolidation, but it's also like getting back to the high impact activities that you as an advisor were doing for years that helped you grow your business. What happens is you wake up one day and you realize, like, wow, I'm spending literally half my day on compliance and other BS activities.
Yeah, it should be client-facing of existing clients, staying in front of them in whatever way, and then going out and aggregating more relationships.
Right.
Those are the two things that, that leads to growth, period, the end.
The other one that I think is a big shift, which is sort of also near and dear to my heart because everybody knows that I like marketing, is this idea that marketing is really not an option anymore, right? Like having a website is table stakes, right? Having a good LinkedIn account is table stakes. It's not special. Like you have to have a website. Everybody has to have one. But how good is it, right? Do you have video? Do you have white papers? Are you doing personal things are you posting? Do you have a team or do you not have a team? Are you doing it on your own? It's become apparent and paramount that advisors really focus on how to build their brand and what is their brand perception in the marketplace. And too many advisors, up until recently, didn't really care, right? The other thing that, and I think we're at the beginning of this stage, actually, right? So it's not necessarily, but it's something that we've talked about when we talk about marketing.
Yeah, for sure.
Is video is the must-have medium now in marketing. Must-have medium in marketing, right? Meaning, what I mean by that is, it's not enough just to post like, oh, it's October planning month, and you're posting a post, or Happy Thanksgiving and happy this or whatever, and you're putting these stagnant posts out that maybe you try to write something on ChatGPT and you get it approved and you put it out there.
It's typical. It's expected.
It's typical.
Right.
In my opinion, it's noise, right? People scroll through that stuff, right? They don't really care until they come to a post that has a video of somebody in a random location, right? I happen to be going through Instagram a while back, just a while today, not a while, but a little while ago. And I went past somebody, their account, and they were in a different environment, right? So it was Billy Bush, right? He does this podcast thing. And he's normally in a podcast studio or whatever. And this time he was in his car. Very much like I do, right? And I stopped and listened because I'm like, why is he doing a podcast? Why is he doing a video from his car? He never does videos from his car, right? And I don't listen to him all the time, but I listened to enough to know that was a different image than I was normally used to seeing. And I stopped and listened. And
that's different.
Because it was different.
Right.
And so the point being, when you think about marketing, and for those of you that don't watch us on YouTube, I'm holding up my cell phone. This is a powerful tool. Your cell phone is a very powerful tool. You should be talking about things that are going on in your business every single day. On our marketing side, everybody knows, maybe not know, we have a marketing agency called Elite Marketing Concepts. We only work with financial advisors. we frequently hear from our clients, well, I don't really know what kind of content I can't think of content, or I don't have enough content. And our answer is, you live in content every day. Every day you have a client meeting, there's content that can come out of that meeting without disclosing who the client is, right? But talk about that meeting. Why was that meeting important? What was the impact of that meeting on your client or other clients? Or how do you work with clients?
Yeah,
there's
client
so
event.
much stuff,
Yep.
right? It's like what we do, right? We talk every day. We've sort of simplified our podcast by not really having to worry about what to talk about. We just like, hey, what'd you talk about yesterday, right?
470 conversations this week. And,
right.
Yeah.
So we just pick topics. And so when we talk about marketing and why it's so important, you have to be unique, because everybody now is doing the basic stuff. I almost said it in language, the basic stuff. So now you have to be unique and stand out. And the way to do that is very simple. It's video.
Well, you get to reach your clients in a unique way. You get to reach your clients in a more personable way. They get to know you in the raw, if you will. They can determine if they like you or not like you. But for the most part, you're connecting with them in a way that most advisors are not comfortable doing. So be different.
And so be comfortable with being uncomfortable and be different. And it doesn't have to be perfect. The best stuff, for me at least, my most watched content is the grainier stuff that I put out, right? I did something the other day. I'm not saying that an advisor should do this, but I posted a receipt I went to dinner. I sort of have this push right now to the end of the year that if you're doing okay, you're well off, right? And you're going out to dinner a lot and having, right? And there's waiters and waitresses and valets and stuff like that working their tails off, doing a job that I wouldn't know how to do, right? I wouldn't have the patience to do it. And so, normally you give 20, or I usually give a little bit more, but people give 20% or whatever. My thing is, give 50% during the holidays.
Go the extra mile.
Go the extra mile, because that 50%, maybe it's $25 to you or $50 to you, which maybe it's not a lot of money to you, but to that waiter or waitress, that's a lot of money. Like, that could be groceries for the week for that person, right? Point is, so do that, right? I'm saying, do that. But I posted my receipt, I was in Nevada at a business thing, and we went to Capitol Grill. And it wasn't like a big expensive dinner. We just got burgers or whatever. Actually, somebody commented, that seems, were you by yourself? Because the bill was only $200. And someone posted, were you by yourself? I'm like, no, I go there all the time. And so for me, I'm just going to get a hamburger and a salad or whatever and an appetizer. Anyway, so the bill was $200 and I tipped $100. So the bill came at $300. I posted it on Instagram, basically saying, let's go. Come on. I'm leading my example.
Game on.
I got 18,000 views.
Really?
18,000 views on my story. Which means it's only up for 24 hours. And I got the most I've ever gotten on any post.
Posting a receipt of paying it forward.
Posting a receipt.
Going the extra mile.
It was a random, it didn't have any information on it. But my point is, do things that are different, right? And do things that are genuine, because ultimately marketing is all about getting the person on the other side to decide whether or not they like you or not like you, and decide whether to pick up the phone or not as a financial advisor. So do things differently, right? And obviously, if you want to talk more about that, you can call us and we can help you. So that's really it. I mean, the last thing, which is, I know is a big one for you, which is the cost of inaction. We talk to a lot of advisors.
The doers of nothing.
The doers of nothing. You want to talk about that a little bit? Sure, it's a pet peeve of yours.
Look, just tire kicking. It's you say it all the time. You're deciding not to decide, and so therefore you're making a decision. I know that sounds a little bit redundant and a bit of a tongue twister, but in reality, and look, it's a major decision. It's a milestone decision for anybody to make a change, as vast as changing firms or retiring or growing your business, whatever it is. But we find so many advisors, and maybe it's fear. Maybe it's something didn't go wrong for their colleague or buddy or whatever, but we see it time and time again. And usually we say, well, we'll probably be having the same conversation in a year from now. It's really the definition of insanity. And so utilize us, consultants, and the knowledge that we provide to help you get over that hurdle, because we see advisors time and time again get stuck in the middle.
Yeah.
And their business is staying the same. Their same staffing problems are still the same. Their same
nothing changes.
Growth problems are still the same. And so sometimes it takes one little ounce of maybe guts, a little bit of faith to take that hurdle, take that leap. And so we're pushing on all of our listeners for 2026. If you're one of those people that's deciding not to decide. Do something for your family. Do something better for your business, your clients. No one ever, in the whatever years, 15 years that Elite's been in business. 15?
15, yeah.
How many advisors have gone back to where they started?
Yeah. Back to where they started? None.
Well, back to the firm that they came from.
Yeah, very few.
Right.
And I say very few because there's some clients that we have, some of them are friends, that they're just, I call them check jumpers, right?
Yeah.
They work out their contract 9 years, they move to another firm,
Right.
They could take a check. But we're talking about advisors that make a mistake. 9 times out of 10, when we move an advisor, what we hear later on was, I should have done it sooner.
Yeah. The success ratio, let's call it that. The success ratio is in your favor.
I have a post from somebody that, not a post, a text from somebody that, you know who that is. Very nervous person to move. This was 2 years ago, I guess it was, right? Super nervous to make a move. They were worried. They were leaving a bank, so they were terrified of what was going to happen. And the banks would come after them and ruin their business and all that other stuff. And we were talking about just texting happy holidays, whatever. And very grateful for you and your direction. And to me, they're super happy with what they did. The move was very successful. And they're really, really happy. And to me, just that little line about being grateful for our direction means the world, right?
You changed my life.
Right. We changed
your
life.
You.
Exactly. And I think you said it best. You think you're not making a decision, but you are making a decision by staying where you are. And a lot of times we go through the economics with advisors, and we'll show an advisor that, if they're considering going from a W-2 environment to a 1099 environment, right? Without choosing a 1099 firm, an affiliation, we'll show them like what the cost of inaction is. If they have a large practice, it could mean 20, 30, we've had some that's $40,000 or $50,000 or more a month that they're giving up. So they're choosing to give their firm $40,000 a month to stay there and treat them that way. And if you're at a firm that has a deferred comp program, right? Well, every month that you stay there and they put more into your deferred comp and you're going to leave at some point, you're just throwing that money away, right? Because you're never going to get it back because you're not going to be there for 7, 8, 9, 10 years. So they're taking money out of your revenue, out of your payout, and they're deferring it. You're just losing that money. So there is a cost for inaction. And I think that when you decide to hey, I'm just not going to do anything, you should understand what that really means versus well, I'm just lazy and I don't want to do it, right? Or if you have stuff going on in your life, I get that. And we have clients that make decisions and they want to make the decision now. We have one client that they made their decision where they're going, but they're not moving till basically fourth quarter of next year. And they have some reasons why, and that's all fine. But so at least now they know they have peace of mind knowing the direction that they're going, and everything that they do this coming year will be with that idea, right? And some moves do take a long time.
Yeah, working towards it.
Right.
At least making.
But if you're going to stay, you need to understand what you're giving up. So anyway, those were the topics, which is why it was a longer topic, because these were the topics that we got a lot more feedback on. We've had some great podcasts that you should go listen to. That weren't on these. We had some great guests coming on. I did one with Mike Durbin from CEO recently. I did a great podcast with John Cutton, and it was like a masterclass in acquisitions because we have Elite Advisor Successions is another business. But John, he's an Ameriprise advisor, the largest Ameriprise advisor on the independent side. Billy gave a masterclass on what it means to be an acquirer of practices and how to use debt and how to look at deals, and it was really great. So, we'll put a link in our post for that. It was great. So, anyway, with that said, we hope that you find this informative. We hope you go back and listen to some of these podcasts, and if there are podcasts or guests that you want to hear next year, reach out to us. Obviously, you can reach out to Stacey at
856-816-6322 or Stacey at eliteconsultingpartners.com. Don't forget the E. Or
you can just email me at frank@eliteconsultingpartners.com. 856-316-4651. I
That's
almost didn't give my number out. Or you can DM me on LinkedIn. Happy to talk with you. Or like a lot of people do, they can DM me on my Instagram account, which is franklarosa.elite. So with that said, we hope you have a great year. Had a great year. We hope you have a great year next year.
Achieve your goals. Put it into action.
Personal and professional.
Yes.
Everybody should be this time of the year, I hope, thinking about your personal and professional goals, the things that you have on your vision board, all of those things. I'm getting one of those things soon for Christmas. I'm going to check off something on my vision board for Christmas. Came in early. Santa came early. Anyway, with that said, thank you very much. Thanks for following us. Thanks for listening to us. Thanks for being a great audience. This is sort of a passion for us.
It is. Thanks for your trust.
We love doing it. Exactly. And we appreciate everything. So have a great rest of the holiday season and see you next year.
Happy New Year.
Thanks for listening to Advisor Talk with Frank LaRosa. If you're looking for more advice or solutions on any topics relating to the financial services industry, or just want to subscribe to our podcast, head on over to eliteconsultingpartners.com/podcast.